Today on the Clinton Donnelly Show, we're going to look at what the IRS called the look-through analysis. And this is an NFT would be considered a collectible if we look through to the underlying asset or right that is connected to that NFT. It's going to be fun. I think you'll enjoy it. Well, welcome back to the Clinton Donnelly Show. I am excited to have Andrew Gordon with me today from Gordon Law. Andrew, the look-through analysis. Is this an appropriate analysis, or is there a better way to make that comparison? What do you think?
I think it sounds better than it actually is, right? The first time you hear it, it's like, well, yeah, you're right. We should actually look through the digital nature of what the NFT is and see, what is this? Is it actually a collectible? Is it something that checks one of these boxes for what we say a collectible is? So on its face, it seems like it should, but when you then really start to dive into it, and you have things like digital art, especially where the ownership rights may vary. In the real world, if you had very limited rights to a certain actual work of art, would you have ownership? The look-through rule doesn't necessarily apply directly, or it can't be used as easily as it sounds when we have things like NFTs that are Bored Apes or things like that. So I think what we're going to have is we already have an issue with compliance. The vast majority of crypto investors and traders don't know how to report properly crypto on their tax returns. And now we're adding a significant complication on top of that, where every NFT project will need the help of a tax professional to identify what is it exactly and does it meet these very vague criteria. I think that's going to throw just another wrench in compliance and trying to get people to come forward and report and pay taxes.
I think that's a great point. I think you and I have bantered this about before. Like, what does that put upon us and our staff for preparing a tax return for an NFT trader? Is the burden on us to determine if his NFT is a collectible? Can we just trust him to tell us? Do we have an obligation to educate him on what a collectible might be? I mean, that's a significant burden.
Right. And then also with respect to even tracking, now all the software out there, to the best of my knowledge, does not differentiate between collectibles and non-collectibles. And so not only will that analysis need to be done, but it'll need to be tracked and reported separately.
That's just a massive hassle. I think a lot of people, a lot of practitioners might just ignore the whole issue unless the client brings it up, treat everything as though it's not collectible.
Yep. It very well could be, which then goes back to the question, which is this the right mechanism, right? And I think the tax code overall has an issue with a massive tax gap, the amount which people actually report versus what should be reported. And does this move the needle and move people towards proper tax? I don't think so. I think we need bright line rules that are easy to apply. This does not do that.
That's a great point. I know a lot of people who tell me they don't file their taxes because they don't understand the rules and they're scared. And this is such a vague rule. It only goes to underscore that uncertainty and lack of confidence that people have in the tax code when they have such an arbitrary proposal coming out. What would happen with the look-through rule when we have, like an ERC 1155 type of token where it's a hybrid. It's partly NFT, partly fungible. And then they also have NFTs that if the two NFTs get together, they can create a third NFT. What if that third NFT has some ownership rights from one of the original NFTs to whatever their underlying asset is? I mean, this could get quite ugly, don't you think?
Right. There are NFTs that you can breed with one another, and then you have offspring. And so, if it's an NFT of a cat, and then it breeds with another cat, I guess cats aren't collectibles, so we're okay there. But then the new offspring has unique characteristics. Is that a collectible? Yeah, I mean, I think things get very murky when it comes to in-game NFTs, I hope the application of the look-through rule would be such that those would not generally represent collectibles. But that's hard to say because some of them are close to art. And that then again goes to the definition of art. And perhaps that's the biggest problem with the current proposal and the definition. It's what the IRS didn't address in their examples. It's what's the most common, and it's what's the most gray, which is how is art defined? Maybe it's something like porn, you know it when you see it. But here, the tax code is not the Supreme Court trying to generate or define porn. It's trying to create very explicit rules that everyone can follow. So we can't just know it when we see it. We have to know what art is. And this doesn't provide that.
One of the questions that they brought up is, our definition of NFT satisfactory? And their definition basically involved that it was a block or token that had a unique digital identifier on it. And therefore, since it's unique and it identified that particular transaction or token, that itself was sufficient for defining an NFT. Are you comfortable with that? Does that take care of the future developments or where NFTs might go?
It's a great question. And it's hard to say because who would have suspected that perhaps NFTs have gone to where they are today with their various different use cases and examples. I think it may provide enough flexibility, but it may be too general. Crypto transactions that are fungible often have unique identifiers. So it's hard to say. Yeah, not sure. What do you think on that one?
Well, you just mentioned a great point that fungible tokens can have unique identifiers. Just think of a dollar bill. It has a unique serial number on it. But the fact that I can trade one for another makes it fungible. It doesn't really matter what the serial number is. So the mere existence of a unique digital identifier may not be sufficient to define it as an NFT. I guess their NFT definition would have to be broadened, that the token or coin itself did not behave in a fungible manner. There'd have to be some sort of test for what constitutes fungible.
Right, which is why we have the two definitions. And I don't know who came up with calling it NFTs years ago, offspring of Satoshi, but maybe that's really what one of the characteristics needs to be, right? A dollar bill is a dollar bill, regardless of the serial number. And so just because something has a unique identifier, if it is no more valuable than another one with a unique identifier, then I wouldn't say that that makes it an NFT. So that uniqueness needs to add to value.
I agree. We've talked this entire talk about NFTs more or less in the context of capital gains, which is what's most relevant to the average investor. But this section 408M really falls into the whole section of the tax code on IRAs and qualified retirement plans. And it specifically calls out existing laws that if you have an IRA or a qualified plan and you buy a collectible inside the IRA, that is to say, whether it's self-directed or the owners of the IRA buy a collectible, that collectible is deemed distribution right at the time that it occurs. That means it's deemed distribution as though it was given to you, and you're subject to potentially a 10% early distribution tax, as well as income tax that would go with that distribution. So all this regulation tends to get into that. I know a lot of people who are doing self-directed IRAs, and I know some of them are getting into NFTs, and this could really set them up for a massive problem if the IRS takes this approach. Any thoughts you have on that?
Yeah, well, I think in general, it sounds like if you were trying to hold NFTs through an IRA or a qualified retirement plan, and this does go through, it wouldn't work. You wouldn't be able to do it. Which, I understand why the IRS would do it with respect to actual works of art, right? It seems almost unfair that you've got a Van Gogh painting in your house and you're saying that should have qualified tax treatment because it's in your IRA. On the other hand, should it be any different if it's a digital work of art that's on your wall? But I think overall, it seems the application would be that NFTs couldn't be held in that type of tax vehicle.
Yeah, I think you're right. I know the whole look through terminology is not novel to this notice, but it actually exists in one of the regulations 1.408-1, where it talks about a S corp or a corporation owning a collectible, and that if there's a sale or transfer of some of the ownership rights of that corporation, that would be treated as a collectibles capital gain distribution on the value of the underlying capital asset owned by the corporation. This is probably what happened with John Kerry. They said he only owned a percentage of it. That's probably owned in a corporation. The corporation owned, the masterpiece. He sold his share, and so they wanted to, catch him on the tax aspects of that. So I can see how very wealthy people would try to use corporations, maybe NFTs, to hide ownership rights to masterpieces that should be taxed at the collectible tax. I mean, I can see where that's going. I guess my feeling on this is, how big a problem is this that we're trying to solve originally with the collectibles tax, to tax these ultra wealthy people on original masterpieces? I mean, and is that really an issue that we have to fight with NFTs? Typically the IRS parades this argument of there's criminal elements that are shifting large amounts of money, blah, 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 and therefore we have to do it, because nobody knows the details of that. They just paint it as being extraordinary. But I think this is an immensely small problem that they're making a mountain out of. And, we know that NFT technology is just beginning. As it explodes into more and more areas of our everyday life, this just becomes a super ugly piece of the tax code. And I really question if the enforcement of it is worth the existence of it.
Yeah, no, I agree completely. I think the number one priority should be having NFTs reported on tax returns, period. And just even at the normal capital gains rates. Then from there, what is the delta? How much is the IRS actually going to recover by having these higher rates on the higher tax brackets on long-term sales? I agree. It seems the juice isn't worth the squeeze when they can achieve a much greater effect by clarifying other rules, and perhaps digital asset reporting overall. This is one that, as we talked about, if anything, is going to decrease the reporting and increase the amount of frustration and headaches from practitioners. And often reporting leads with the practitioners, the CPAs, the enrolled agents, the tax preparers out there, and their knowledge of the law and the space. And as we make crypto assets more and more complex for them, how much is the IRS really going to benefit? I agree, Clinton. I don't think there's a whole lot out there on this issue.
So, Andrew, can I steal your phrase? The juice isn't worth the squeeze. That's priceless.
It's all yours.
Right. That might be the title of the paper we send to the IRS.
Maybe. So
I think we've pretty much chewed up the whole realm of collectibles in this whole flawed proposal. Now, the IRS has asked the first time for public comment on anything with crypto. It turned out that there was a court case, I believe last year, where they lost the court case because they were enforcing a ruling where public comment had not been allowed. And the court said, hey, IRS did not allow for public comment. It is not the way rules are made. And they overturned it, and the IRS lost. So I think this is a little bit one of the first tastes we're seeing of this here. The question is, are they going to listen to us, or have they already made their minds up ahead of time? If they haven't listened to us, if they continue to go forward with this, I just think, they're going to lose in court. If the auditor tries to push this issue, you just drag it up to tax court. There was a great quote from John Cordon, who used to be an IRS senior counsel, and then he moved over into management at the IRS. I think at one point, he was the head of the cryptocurrency compliance campaign. He's retired from the IRS. He was on a podcast with Laura Shin, Unchained podcast with Sheehan. And this topic came up of collectibles. And I thought he made a very interesting comment. He said he didn't think that the IRS counsel's office wanted to get into discussing what constitutes a collectible in court. He said they would not want to talk about that, and they'd make sure that case didn't go to court. I thought, oh, that's a insightful observation. Just because you can write the law doesn't mean you want to defend it in court.
Which is, I think, also why we see that there hasn't been any case law on collectibles, and also with several other areas of crypto tax reporting. And I know we both have many, many examples. We could go on another episode, but even very simple things like FIFO versus LIFO and staking, other than the Jarrett case, you don't see that many because the IRS doesn't want to set precedent. They don't want to set hard rules. And one of the attorneys at our firm was at the IRS for about 40 years, and he always mentions to us that once the IRS creates a hard and fast rule, it now creates a framework for others to try to figure out ways around it. And so by leaving some of that ambiguity out there, the IRS can use it to their benefit, and other people aren't able to find the loopholes around it. So perhaps, they don't want to set precedent. They don't want to go through these issues for several reasons.
Very interesting. All right. So I think we've gone through the IRS questions. Is there any other aspect of this we need to go through?
No. This was great. I think we were very thorough.
Well, this was a lot of fun, Andrew, talking about these cases that come up. We should do it more often.
Yeah.
And I think it's just, people shouldn't be scared of filing their taxes just because there's some gray and uncertainty. There's gray and uncertainty in life all the time. And you just need to make sure you find, talented practitioners who can defend you if it's something that the IRS wants to dicker over. Don't panic. Just be confident. I mean, as much of this gray stuff is gray because the IRS doesn't know what they're doing, and they don't want to fight a lot of it. So the auditor might take a swing at it, but doesn't mean that they'll win if we push it in court and appeals. So anyhow, tell people how they can get a hold of you, Andrew.
Check us out online. Our website is gordonlaw.com. Twitter, Gordon Law Ltd. We're also on YouTube, really all social media channels. We've got a lot of free, useful information on crypto tax reporting, tips, advice, ways to stay out of the IRS's crosshairs and minimize your tax. So check it out.
All right. Thank you very much, Andrew. And everyone, if you could please click the like, subscribe, and follow buttons so you know the drill. Your feedback is very important for helping to get this message out, and share it with your friends. Thanks, everyone. Until next week.
Welcome to the Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive audit defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like audit defense membership. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.